Yeah. I'm going to introduce you and say that this is the first time I've met the students, so I should say hello as well. You all right? Ready? Good start on time. You love that kind of thing, don't you? Got a pen. You ready? Yeah. Good morning, everybody. My name's Neil Keller. I'm a professor of finance in the business school, and I co-run this program with Tommy Denver at the back there, who you may know from computer science. This is a shared module between those who are interested in computational finance and those interested in finance more generally. And it's a module that's been running for a number of years now. It's been very popular because it's one where we try each week, no, we don't just try, we do, bringing in people with expertise from City and the wider financial industry generally. And so it's a really interesting module, and I'm sure will be very interesting today as well. As you will know, part of the module and the way that it's assessed is that you will write executive summaries on each of the lectures. Okay? So it's important, and there will be bits in the handbook about how to do that, and if you have any questions about that, but it's important you take notes. Many of these will be available on Listen Again, but not always, because remember, these are outside speakers. So some of the time they won't wish this to be on Listen Again. Now some of the slides will be available, so for example for this lecture the slides will be available, but sometimes they won't be. So you need to make sure you take good notes, okay? You can discuss these things with each other and with me, and we'll go from there. Okay? Alright, well it's my pleasure to introduce Guy Sears. Guy's a solicitor by background, lots of experience in the relationship between finance and regulation. Okay, he was interim chief executive of the Investment Management Association, and so we're really privileged to have him here to speak with us today. Guy came to talk last year, gave the students a really interesting talk, and I'm sure we're going to get more of the same this week. Guy, the floor is yours.
Thanks. So, my name's Guy, as you hear, and you'll get the slides. I know very little about finance. I used to represent the asset management industry in this country in lobbying and legislation and assisting them in running their businesses. I was responsible for representing an industry of round about 4 or 5 trillion sterling. That runs in the United Kingdom, and I'll talk a little bit about the asset management industry. But what I want to give you, because you're obviously people for whom numbers and finance is your interest, what I want to give you is the contextual framework in which businesses, banks and insurers and asset managers operate, and to help you understand some of the ways in which regulation both has developed over the last 30 years, but also now governs some of the sort of future directions and the constraints that are put upon financial businesses. So what we're going to do is we're going to look at how regulations develop, what it's about, and then we're going to look at some of the emerging themes in regulations to do with competition, behavioural economics, and value for money assessments, as well as financial stability on a global basis, to try and put those into context for you. So you can understand, as I say, if you go into that industry, into financial services, to have a slightly wider understanding of what goes on. So that's what we're going to cover. So there will be no numbers. I will not mention logarithms or anything like that. I do not understand any of that. Fortunately, as a scientist, like your sort of scientist, I read natural sciences at Cambridge, so my life is sort of behavioural evolution, and now into financial services.
Can I just ask a quick question?
Nilo.
Yes, as a non-scientist, are you happy to take questions through the presentation, or would you prefer them at points during?
So why don't you're very welcome to ask questions as we go along, particularly if it's to clarify things. Please ask the question. If it's the question that you just want to be clever about and say about, why not wait till the end? And so when we finish each slide and I go on to the next bit, if you've got some questions, do ask them, okay? Do feel free. Is that okay? People all right? As Neil said, all of the slides will be here. It's quite hard to read some of this. So what I'm really looking at when I talk about regulation, what I'm thinking about is just the ways in which the state or state-approved bodies impose rules upon businesses for some sort of greater good or for some rationale to do with either protecting people, protecting the markets, securing the stability of the state, things like that, okay? And these areas of regulation, so I'm not going to get hung up on whether I mean regulation or supervision in other countries. This is really about how we govern those capitalists, essentially, who otherwise will sometimes do things that are slightly misguided or unfortunate. Look, banking regulation, banking has got a very, very long history. I appreciate I'm saying it from a European point of view, but even in Europe, banking in medieval times was very developed. And the word bankruptcy, if you know it, the word bankruptcy comes from an old sort of Italian bancarotta, which means broken bench. And it was the recognition when traders could no longer meet their obligations, their trading bench was smashed. Broken, and they were not allowed to trade anymore, do their money lending and such like. And that bankruptcy ideas are still with us. So even in those days, one of the things that happens was a complete failure of a business. And we'll be looking at how regulation's been addressing some of that. Insurers have a very, very long history. Again, in the West, 1851 in New Hampshire, they already had legislation regulating insurers. So a long time in that. But as you may know, the development of a lot of the regulation occurred around the time of the Wall Street crash, 1929. There'd been attempts beforehand to bring in regulation, and just as we see today still, because there'd been an upturn in the market in the mid-20s, after some crashes in the early 20s, a lot of the lobbyists and the businesses actually stopped Congress proceeding with some of its legislation. And it was only after the catastrophic crashes in 1929 that a lot of people started learning the lesson, and they brought in the legislation that is very well known, as you've probably heard of, the SEC, the Securities Exchange Commission, which started in 1933, 1934. So the United States were doing that around that time, and the SEC is there to protect investors, maintain fair and orderly markets, and facilitate capital formation. You'll see the echo with the way in which the UK and Europe has approached this. Now, the United Kingdom really only started bringing in serious regulation the way we recognise it today 30 years ago. And in fact, on the 28th of April this year, that is the 30th anniversary of the commencement of statutory regulation in the UK in the form that we see it today. And this came about because in the 1980s, there was growing concern that investors, the public, were not being sufficiently protected. But there was also a recognition, and Professor Gower did a series of reports into this, a recognition that many economically substitutable investments were being regulated in distinct and different manners. So just to explain that, unpack that a little bit. You will appreciate that in order to get economic exposures of a certain type to certain risks, there are many ways in which you can structure that. The reality of a lot of the ways in which certainly the UK and Europe has always operated, and the US, is that it's almost the legal nature of the entity that creates these products that determines how it's regulated. So banks and insurers and securities dealers are all seen in different ways and regulated in different ways in the past. And it meant as well, therefore, that insurance products and securities products, that when you looked underneath them, were broadly giving you the same sort of economic exposure, were regulated in very different ways. And if you think about consumer protection and how people make decisions and decide what to invest in, it is unhelpful to people who are broadly financially unsophisticated and have little information, and certainly are subject to a very large information asymmetry compared to the providers. It's very unhelpful to them to present things in quite distinct and different ways and prevent them making a proper comparison. And amazingly, despite the fact that 30-something years ago, this was one of the reasons why we introduced the sort of regulation we did, and Europe has this sort of regulation, we still have not addressed this problem. And there is still different treatment of economically substitutable investments because of the fact that they may be insurance or banking products or securities products. And so we still in fact have these echoes, as you'll see, of a very long history of different sort of powerful groups in the state and different powerful businesses rather than approaching it from a consumer point of view. And one of the things I'll tell you is that there's been a European piece of legislation commenced days ago called the Package Retail Investment Products Regulation, which for the first time tries to ensure that economically substitutable products are presented in their information packages in comparable form to the public. And literally just a few days ago that legislation came in. So we're looking at 30 years of actually not addressing an issue that everyone has known has been around. You'll hear that I'm not always a huge supporter of the way in which regulations gone. I just need to explain my background. At one point I was the solicitor to the Securities and Investments Board. I ran its litigation in the courts for 3 years, and I was head of market conduct and market infrastructure at the Financial Services Authority. So one of my sort of previous jobs when I was just younger, in my 30s, was as a head of department in one of these. Now, Europe has got a whole range of things, and some of you may even have heard of a thing called MiFID, which has been making the papers, which is a Markets in Financial Instruments Directive, MiFID II. I'm one who followed these and actually negotiated and lobbied on negotiating these directives for 20-something years. And I was saying to Neil beforehand, it's amazing to me how we are now finally, people are realising the huge impact that these regulations have. And MiFID II, which I may touch upon, has just as of the 3rd of January changed the way in which transparency on the bond markets will operate across the Western economies, changed the information that's given to people, and changed some core obligations on the nature of trading venues that can exist. And those of you who may know about dark pools and have read about dark pools, as of the 3rd of January, the way in which dark pools operate has had to be changed significantly, and certain operations have now been banned because of European legislation. Let's roll on to oops. Now, what you always see in regulation pretty well the world over, and it's reflected in transnational bodies and international bodies, as you'll see, is, or supranational bodies, is this 3 divisions. And essentially most of financial services businesses are regulated under one of these 3 columns. And these 3 columns in some countries are hugely distinctive. In others, they have integrated regulators that look across it. And the 3, unsurprisingly perhaps, are banking, insurance, and securities. And they are seen and addressed in distinctive manners. And essentially, the classic with banking, as you'd expect, is that there's a focus on prudential strength, that is the ability to withstand risks to which the balance sheet of the business is going to be subject. They have the people who are interested in them, the characteristic person who's interested in them are central banks, unsurprisingly, because of the credit that they can create. There's Basel, is one of the supranational bodies, as you may know, that sets regulations. And in Europe, there is a European Banking Agency authority that is responsible for a lot of the rules and the approaches on trying to harmonise approaches on banking. Okay, insurance, again, a prudential concern, but also some conduct. Conduct is, of course, the manner in which you carry on business and the manner in which you control your internal operations. There's specialist regulators in insurance, particularly because of the nature in which you have to assess risk and analyse the sort of balance sheet risk in an insurer. It's very different than a bank. EIOPA is the European body. In the securities markets, a hodgepodge of different approaches, but certainly conduct, some prudential concerns, and a very wide range of activities get shuffled under this, from investment advice to the operation of the securities markets themselves and stock exchange operations. These also have a different nature of risk, and the risk of saying the obvious, I just want to say it so that we're all on the same page, and that is to say this: that banking is different than stuff that goes on in the securities markets. And from a regulator's point of view, one of the key things, which is just very straightforward, is that in order to fulfill your promises, if you're a regulated firm, in order to meet your obligations, if you're a bank, you need to have a solvent balance sheet. In other words, the nature of the promises that a bank makes to people is about the performance of its balance sheet. When you leave money with a bank, as you know, you have no property in it. Certainly in English law, you have no property. You don't have money at the bank. What you have is an indebtedness from the bank to you. And if the bank is not solvent and cannot meet its debts, you have no money. This is a very straightforward thing that people often just get very confused about. You'll often hear people talking about their cash at the bank, and my cash is at the bank, and my money is at the bank. And there is just nonsense, of course. You have no money at the bank. What you have is an indebtedness from the bank to you, and that's the shorthand. You might think this is obvious. I had a client years ago when I was a solicitor who sent us in a cutting, an extract from a local newspaper. And the cutting said that there had been a robbery at the local bank, and that the thieves had got away with some £100,000 or £200,000 of cash. And this woman wrote into us and said that she was very worried because her money was at this branch, and she wanted to know that her money was still safe and that the robbers had not stolen her money, and that she'd written to the bank and the bank told her her money was safe, but she didn't believe it because whose money had been stolen? Now, this is a very easy mistake lots of people make, but funny enough, it's actually a mistake that is made sometimes by regulators deep down who talk about protecting money and protecting client assets. So banks just have the balance sheet. That's what you depend upon most of the time. They do get involved in mis-selling, but basically that's always been the focus historically. Over here in the securities markets and advisory markets, you'll appreciate that if you go to somebody and you ask their advice about what to do for your retirement or for savings, what you depend upon is the quality of their advice. That's what matters. It doesn't matter whether that person is worth £30,000 or £300 million on their balance sheet. Of course, it has an effect if the advice is bad, but what you need is good quality advice. With banking, you need strong balance sheets. So quite obviously that's been the history and the separation. But this has led to some profound blind spots. This has led to situations in which, where it has been quite well known by regulators, and I'm not talking about anything in my time because it's a criminal offence to discuss the things that are confidential that I'm aware of, I'm talking about public stuff, where it's reported in the papers that banks were mis-selling various products and causing therefore loss to people, that the banking regulators were concerned that there wasn't too much adverse publicity, so there wasn't a run on the bank, people didn't withdraw their deposits and the bank would collapse. There was a clear conflict between the prudential supervisors and the conduct supervisors over mis-selling. Because although these people have lost millions of pounds, if you cause too much of a panic and people withdraw their money from a bank, as you know, they collapse very quickly. I can't remember broadly, maybe some of you know, but I mean broadly every pound that is deposited is maybe 10, maybe 20 times at the moment. What's the sort of gearing? 20 to 30 times maybe the Western banks are geared at. So you only need to lose 3 to 4% of your deposits and a bank's in a lot of difficulty. just run out of cash. So, because of this conflict that has occurred on many an occasion between do we protect the public, do we keep our banks safe, because the banks also have this role in running the payment, being part of the payment system, as well as often being seen as national treasures, which is a terrible danger in itself, but anyway, they are sometimes seen as national treasures. This conflict has often been addressed in the way we've done stuff. So in 1988, when regulation was introduced, as I said, the regulation was in this area. In 1988, the government in the UK left banking with the Bank of England, left insurance with what was then the Department of Trade and Industry, so BIS today, Department of Trade and Industry, government department, and securities came under a thing called the Securities and Investments Board that I work for, and a range of self-regulating organisations in different areas that dealt with those sort of areas of the market, from the securities dealers to the investment advisors to the asset managers. But people felt that wasn't working well, and in 1998, with the change of administration in the UK, we had a new regulator that brought all these and some more together, the Financial Services Authority, the FSA. Now, just as an aside, the development actually in the UK, if you know, of regulation and such like, is in a sense sort of not really what government were doing. And what really was happening, I suggest, in Blair and Brown's approach, certainly Gordon Brown's approach, was not so much bringing these all together. That was seen to be necessary. But what was happening over here is that we were carving out monetary policy. And we were bringing in an independent monetary policy committee from the Bank of England, and it changed the role of the bank. So as the regulators developed over here, much more significantly outside of regulation, we were changing the nature of independent monetary oversight. And you'll hear how successful or unsuccessful I think regulators have been. But in 2013, the latest iteration is that what has happened here with a new government again is that yet another thing has been created, which is the Financial Policy Committee, the FPC, and the prudential side of these businesses have been separated once again. And so into a thing called the Prudential Regulation Authority, the PRA, and over here we have the Financial Conduct Authority, the FCA. So as you see different administrations, different governments, those who are more to the left, more to the right, as they approach the world, what actually has happened is pretty well every 12 years we've had a complete shift in the way in which we organise regulation and how we're trying to address it. And this is a reflection of the fact that no one really can agree what on earth the priorities of regulation are and their importance, but it's also a reflection of the fact that there's been a trend in the state to move monetary policy and financial and fiscal policy out into these fairly autonomous bodies. So this is where we are today. Now, I don't know whether you've ever looked and thought, what on earth does a regulator do? But the regulator exists to do three things in the UK at the Financial Conduct Authority: to protect consumers, to protect financial markets, and to promote competition. These are easily said. And you'll see there's usual weasel words by lawyers to say secure an appropriate degree of protection for consumers. And the great thing about this is that the legislation can say that, and then they leave it to others to work out what the appropriate degree of protection is for consumers. I would guess, if I asked around this room or you had a discussion, we would come up with quite a range of different views on how much protection consumers should have. For instance, if you had the picture of an elderly person going along to their advisor with their life savings and asking what they should do, I would guess many people would think that they ought to be given some protection and looked after, and know that the advisor had good quality advice, was properly qualified, was subjected to continuing professional development, and that if it turned out that the advisor had given poor advice or had failed to ask sufficient questions, that advisor should compensate them in some way. And I think a lot of people see that, that's the classic sort of vulnerable person. But on the other hand, what about where people see an opportunity for a high-risk, high-return investment with, let's say, the disposable part of their income? Let's say they've got £1 million, they're a higher net worth individual, they've got £1 million that they can just spend on a particular high-risk, high-return product that then turns out to go wrong. Let's say they hope in this day and age, instead of maybe getting a return from your bank of less than 0.5%, maybe a return on the markets at the moment of something between 10 and 15%, if you're really doing well, let's say it promised an opportunity to get 25% return over 3 years continuously, but with a high risk, and it fails. And then they run crying to the regulator and say, I haven't been protected. And some people say, so what, bad luck? And so there is a need to think about how much you protect people. What if you're one of the biggest asset managers in the world and you deal with Goldman Sachs International because you want to put in place a 50-year forward inflation swap for a big pension scheme where you're looking after, let's say, 300 million mandate, and you need to just protect that pool of assets against inflation changes for the next 50 years. You're a client, and Goldman Sachs is the regulated firm. How much protection should you be given there? And this has always been very difficult to get the balance, and I'll talk to you about how badly everybody has failed in doing it in a bit. Protection of the financial markets. Very interestingly, of course, the front, not that I would have ever read a newspaper when I was at university, but the front page of the Times today is all about allegedly the failure to properly look at market abuse on the financial markets, and it is certainly the case that there is good historical evidence that there has been a sort of sociological, political bias against criminalising white-collar crime. Seeing insider dealing as a crime was very late on. In the 1970s, it was still perfectly acceptable in any proper sense of those words. People found it acceptable to use insider dealing. And it really is only in the last 40, 50 years that it's been seen as criminal. Indeed, there were many people who, in the US and elsewhere, who lobbied against it being criminalised and suggested it was appalling. It helped with market efficiency and things. So. And the other one in promoting competition. This has been a very interesting battleground for years, and this is one of the areas which is the new development of regulation, the new direction of regulation, is to look at competition. Because before, competition authorities looked at competition. And of course you can say you should be able to promote competition in the sense of think about how regulations are made, make sure that you're not preventing innovation unnecessarily, don't over-prescribe, all those sort of things. But actually there's a wider interest now in promoting competition because through behavioural economics, people have realised that these tools of looking at how businesses compete and what they're competing on and the nature of the information they give people is sort of protecting consumers and promoting competition and improving the integrity of the markets can all be captured together, and the regulators are quite interested in this, and I'll come to it. One of the things this isn't, and which the Western economies as a rule do not do, is promote the competitiveness of their country. promoting competition is not the same as promoting the United Kingdom. It is not the role of regulators to promote their sort of national businesses. That is the role of government. And one of the things with regulation is it is a deliberate division between the role of government and the role of regulators when it comes down to competitiveness. To explain it perhaps, where some countries have been criticised in the past, and certainly some territories have been criticised in promoting competitiveness, is that if your regulator is actually going around the world promoting your country, it's obviously very tempting for that regulator to make sure that the rules that they have are not too tough and that they want to welcome businesses in. And it has for generations been an issue that some countries have wanted to lower their rules, the protections they have, maybe the requirement to have capital in that country if you're a bank, the level of capital you must have, in order to attract business into the country. And so many of the legislators have realised that giving this role to a regulator is actually quite dangerous, and it's better to allow the state to deal with the competitiveness of the UK, promoting us and all those sort of things, and for the regulator to deal with, of the businesses that are here, what are the standards we should have and how do we properly protect both the markets and consumers. Prudential Regulatory Authority, you'll see, is in the modern way now no longer addressing, as 30 years ago, that the role of the prudential regulator used to be to ensure that the balance sheets of the individual businesses were sound, okay, that there was prudential strength in them. Now, the language we use after the financial crisis is to ensure that the business of these firms, of these businesses, is carried on in a way which avoids any adverse effect on the stability of the UK financial system. So whilst before people always looked at individual businesses one by one, what we've seen over the last 20 years, and particularly since the financial crisis, is a much more, overused word, but holistic approach which looks at financial stability of the system as a whole. And this is profoundly difficult for regulators, and international regulators are still struggling with it. And I'll come to some of the things, maybe I'll just mention it here, I think. To explain. Have you heard of CDO squareds and CDOs and collateral debt obligations? Okay, well, trust me, before you arrived here, you know there was a financial crisis. Well, one of the reasons why the whole system melted down were certain products like CDOs, CDO squareds. And if you haven't read about it and you don't realise the sort of problems that come from the fallacy of composition, then it's an area that's worth looking at before you all think you're superstars in finance and you blow up the world again for me when I'm retired. There are times at which some products that financial institutions create are inherently stupid and dangerous. There have been, in the early days of some of the complex derivative products that were put together, they behaved in a similar manner to certain iterations of the Windows system in operations. You know, they would suddenly crash. So there were times at which some of the very complex derivatives in the early days, even though not a lot was made about it publicly, caused shifts on the indices, the global indices, around pricing moments, and they bounced it because of just a very complicated way in which some of the derivatives work. There are other products that in and of themselves aren't actually dangerous, shouldn't be banned. But if everybody's doing it, they can give rise to a dangerous situation. I'll give you a couple of examples so you understand what I mean by dangerous, because it's not that dangerous. When people manage liquidity risk, that's the ability to convert your asset into cash, because if your investors need cash back, yeah, your liquidity risks. When you manage liquidity risks, what you do in running, let's say, a large bond fund, is you're measuring how quickly it would take you to sell different percentages of that fund. Okay? So if your investors ask for their money back, some of the people who are invested in products, they can ask for the money back on just a few days' notice. So you can imagine that if everything's going well and people are confident, people will be staying with the bond fund. But let's say, hedge fund if you will, let's say that people start losing confidence, the performance goes down, and classically what people always do is they start pulling out when performance goes down. It might actually be the wrong thing to do, but that's what people do. Might be the right thing to do, but people will just do it behaviourally. They'll see the performance going down. And let's say 5% of your owners need the money back in 3 days. What if it's 10? What if it's 15? And people model this, okay? You model it pretty well on a daily basis, and you watch these liquidity risks. How much could we take? When the Bank of England, in the Bank of England review that comes out every quarter, when the Bank of England 2 years ago went around the City of London and asked people, how are you managing your bond fund risks? Because there was a lot of discussion that some of the Far East economies, there was concern there'd be a downturn and people would be pulling out of the bond funds. How are you managing your bond fund risk? Everybody had a very good plan. Well, if this happens, we're going to sell this much. If this happens, we're going to sell this much. The only problem was that although each of them had a very good plan, and it looked very sensible, taken as a whole, since they were all pretty well the same situation, taken as a whole, in total, they were all planning to sell 3 times as much of the daily volume that we ever see going through the markets in good times. In other words, sat alone, each of them thought they were acting very prudently, carefully. Or would we be able to sell £200 million of this bond? Yes, we can sell that. That's only a tenth of the market. But of course, if you've got 50 people doing that, it's impossible. And this is the issue that regulators look at. It is the fact that businesses can't see everybody else, and sometimes they will argue that what they're doing is very prudent, and what you can say is, I'm afraid, because each of you are doing this, we're going to have to make it even tighter on you. And that's one of the things, really, that financial stability is working on. How do we work on these models and tools? Because what if it's a situation in which the market is already saturated, as the financial stability regulator, you're okay with it, and then one of the banks wants to expand? Do you just tell that one bank not to? And why should the other 4 be allowed to carry on making money? And if therefore you've got to dial everyone down, how do you do that? Do you tell them to start liquidating positions? It's a profound problem that they're still struggling with, and really they haven't got very far. The only place in which, in my view, as I've said on some of these projects, the only place in which we have a model in which you can do this, you can require everyone to behave in a certain way and do it in this much more dynamic way. Okay? The only places are these. Firstly, the state does it at times by changing taxation. Secondly, regulators can do it, but slowly, by changing capital weights. Now, you know this, but when businesses carry on derivatives transactions, other transactions, they're required to hold capital against it. It is a way actually of controlling the amount of business they do. So they don't just generate credit, and generate contracts. There's a cost of their capital to each of these, and you can change that weighting. You can make them put aside more capital for trades, and therefore they'll do it. You can change things like taxation on homes as we changed the stamp duty in order to try and calm down the UK housing market. That's the state account. But when it comes to securities markets and the wider markets, where it doesn't, your promises don't depend on balance sheet because you're, buying and selling stuff. What really we only have are things called exchanges. And stock exchanges really are the only place in which we have well-developed collective approaches to rules and controls by an exchange controller, in which all the players have to watch those rules and meet them and change how much they're putting aside for clearing, stop trading at certain times when the market's disorderly. And at the moment, the regulators globally are struggling to see how, basically, you can apply that sort of approach to the globe. Ha ha ha. It's not going to happen, but they're happy to try, and they're going to keep trying.
One of the classic situations of this was 2008, when many hedge funds were short Volkswagen for various different reasons. And what they didn't realise that Porsche, involved in that, had many of the option contracts on those things. So in fact, there wasn't that much Volkswagen stock available to get hold of when you needed to, give back the stock. And what happened was that briefly Volkswagen price jumped 600%, became the most valuable company in the world, and many hedge funds went bust. And it was one of those moments where it was because nobody knew what was going on, nobody knew what anybody else held.
Yeah.
All those option contracts weren't on exchange, they were bilateral, over the counter. No one knew what happened. Many hedge funds went bust. And it's a very difficult thing for regulators to get behind, isn't it?
Yeah.
Because companies don't want to share that kind of information. Anyway, sorry guys.
No, absolutely. So when I was at the regulator, I introduced some colleagues, I was in charge of the project, the first market code for the United Kingdom that set out in slightly more detail what was seen as acceptable and unacceptable market behaviour in terms of market integrity. And one of the things I pushed very hard was reckless shorting. In other words, shorting your positions in shares without having any idea of where you're going to find the shares to deliver them. I was enormously opposed. There was huge opposition from the market. How dare the regulators suggest that decent businesses should not be allowed just to short every share they wanted to for as long as they wanted to, without regard to settlement. I don't actually care if someone shorts a business. I think it's quite an effective way sometimes of finding the spy. But the notion that, as Neil said, everybody could short something, so you're selling ahead, and not have any thought as to whether or not there were the shares to meet your obligations to sell them on. Anyway, it now is the case, and funny enough, ironically, the first fine under the market code was for a firm that shorted without having cover, even though there were about 15 other headings. It was the one that everybody said would never happen. So, just to take through, so this was the approach, as I said, prudential strength, consumer protection, market integrity. How well have we done? Well, you might think, because of the financial crisis and such like, that we haven't done that well. With all this regulation, particularly in the West, the financial crisis last year, there was a fairly good estimation that the financial crisis, the 2000, whatever, well, 7 now, 8, had cost the United States something like $13 trillion in economic output, and had wiped about $9 trillion off the wealth of homeowners. There was a single event in the UK, you would have never heard of it probably, a business called LifeMark, which was a Luxembourg vehicle that was making a play on death policies. Do you know this? I find it offensive myself, but one of the things that's done is people have long-term insurance, and when they die, there's a payout. Okay, and that's a standard product. Okay, and there are in the United States there are a significant number of people with HIV/AIDS who can sell their life policy, and there are funds that collect these together and invest in it because you're making a play on whether or not the person is going to die more quickly than the insurers expect them to die. not very attractive, but you know, everything gets monetized in our world, I'm afraid. LifeMark had a ton of these death bonds inside it, and people all invested in it. Anyway, one event, you've not heard of it, through a single intermediary in the United Kingdom, £330 million in compensation paid to people in the UK. Just one single case. Payment protection insurance, which is on credit cards, as a mis-selling in the early 2000s. You often see these adverts, PPI, have you had PPI? Why don't you claim? You haven't seen the adverts now. I've given you the thought you will because of confirmation bias. You'll see them everywhere now. And PPI, today, something towards 30 billion sterling has now had to be paid out by UK banks and building societies to people for mis-selling a tiny insurance product on the credit card or on a loan. 26 billion. So the system, in one sense, might have done quite well. Some people thought the system hadn't done very well. This is why we brought in a much greater sort of view that the regulators want to have, and as Neil touched upon, and certainly from 2009, the G20 required much more to be done in terms of derivatives to be put on exchanges, and that's one of the things MiFID's done. So as of the 3rd of January, there's another raft of things that now need to be exchange traded rather than being left OTC between businesses, and so there's a much greater understanding. You may know, as an aside, that one of the upsides of the financial crisis, I'd say it, you know, slowly, given the number of people who were affected by the financial crisis, one of the upsides was finally that sort of hegemony of the Western economies was broken, and we created the G20 rather than the G7 and the G8. And actually, if there's one good thing that came, in my view, from the financial crisis, it was a final realization of these Western economies that they couldn't stand alone and exclude many of the other global economies.
Just another good thing, of course, food prices fell as well. From that. So
okay,
2019, food prices were much lower because they've been boosted so much by financial markets. So.
You might have read that, hopefully you can't. So I'm going to ask you a question now. I want to introduce you to two other things that are done in regulation, particularly in the UK, but there are other places it's done. There are two words in the English language that come from Swedish, I think, directly. Anyone know what they are? Why should you? I think there's, I think it is Swedish. Smålskeborg, and the other word is ombudsman. And the ombudsman is the role we have, the Financial Ombudsman Service, which is an independent party, it's an organisation, individuals, to which you can take your complaints. But in the UK, if you have a complaint against the regulated firm, you go to the firm, and the firm is required to handle your complaint. And regulated firms have to handle your complaint in a way completely differently than, you know, power companies or shoe shops or anything like that. All complaints are recorded, and if a complaint is not dealt with to the satisfaction of the consumer in 3 days, it becomes a sort of elevated type of complaint for the statistical reporting. And if it's not dealt with in 8 weeks and fully resolved, you can go to the ombudsman. Or in fact, if you're unsatisfied with what the firm says to you, you can go to the ombudsman. And people can take their complaints to this body, and the body is funded by basically a tax on the whole industry. And you can take your complaint, and it costs you nothing. You know, you don't have to put up any fees. And if the ombudsman finds in your favour, a regulated firm is bound to comply with you. It has to comply with what the ombudsman says. Now, there is a limit to the amount of money the ombudsman can give you. I think it's about £100,000 is the compulsory thing. But if, therefore, you have been dealt with badly by a financial services business, you complain to them, they don't then satisfy you, maybe sort something out, maybe pay you some money for your time and upset, the Ombudsman can award up to £100,000 and the firm has to pay it. And if you don't win before the Ombudsman as a consumer, you still have every right to go to court if you want to continue. So it's a one-way option to protect people. So the United Kingdom has, what, I don't know, 40 million, 38 million, somewhere around there, adults. How many complaints were there in the last half of last year in the financial services system? So if somebody wrote in saying that they were dissatisfied with the service they had, angry with it, didn't like it, whatever, if there's an expression of dissatisfaction, it needs to be recorded to resolve. And as of last half of last year, every complaint is now in the stats. What used to happen is if you resolved it within 3 days, it wasn't in the statistics, which was quite good because everybody had a real desire to sort everything within 3 days, because then as a bank you look pretty good. But the reality was that these things can play out either way. And the fact of the matter is the regulator, I think quite properly, now requires firms to publish there within 3 days, they're within 8 weeks, and others. Yeah. Just roughly, how many complaints do you reckon there were in the last 6 months of last year in the UK? Don't worry, I wouldn't know. I looked it up. So, in 6 months, in half a year. Don't forget, this is financial services. 100,000? 300,000? 40 million people in the country, half a year, 3.3 million complaints.
How many people though?
Well, that's fair. One. I wrote them all. 3.3 million complaints. 97% of that, so you work it out, but just about 3 million were by only just over 200 firms got them. So the majority, as I say, the big firms, which will be the big banks and big insurers, receive 500 or more complaints each. So about 1 million of them with this payment protection insurance. It's been around, it's been a terrible thing for a long time. And the next most complained about thing, so there were 500,000 complaints in the first half, I beg your pardon, first half of 2017, it's on the slide. 500,000 complaints on bank current accounts, and people's complaints about credit cards, 300,000. Now what's interesting is that about 59% of complaints were upheld by firms. In other words, 6 times out of 10, if you will, 3 times out of 5 of the complaints, people were found, the firms were satisfied that the complainant was correct. Now that sort of fail rate is pretty poor in my mind. If one had that, matter for them really, but I don't think that's terribly attractive. And about 2 billion of redress was paid in the first half of last year as part of the complaint structure. This is not people suing them. This is not the regulator requiring it. This is their own review because somebody has bothered to complain and has led to 2 billion. Now, I don't know about you, but that might not strike you as a sort of measure that regulation is being entirely successful at the moment. But maybe on the other hand, it is quite a good measure because 2 billion is a lot of money, but it's not a huge amount of money in the scheme of things. The regulator itself, the Financial Conduct Authority, its budget is somewhere around £450 million. So this, businesses have to pay something like £500 million a year anyway to run the regulator. And even when you correct it, packaged bank accounts, these things where like you have an offset and things, you can have a mortgage with a bank account, things like that. Okay? 23 complaints in 1,000. So over 2%. You imagine if you were doing a business in which over 2% of the people you sell to raise a complaint about your product. Imagine if you were just looking on sites of reviews. But anyway, that's where some of the financial services stuff is still. We're going to take a quick break, shall we, just so people can refocus their heads for 5 minutes, and then I want to talk to you after that about, as I say, the behavioural economics and some of the competition stuff that's happening. Good. So, sort of, I've dealt in a sense with the past, whether or not it's worked. I think there's been some successes, no doubt, and you know, it's always hard to know what the counterfactual was. In the absence of regulation, how bad would it have been? But nevertheless, we've had a global financial crisis. Still, billions are being paid out in redress to people. There are a very significant number of complaints, even in the United Kingdom, 3 million every 6 months. And the question is, have we actually got it right? And is there a different model of regulation? In my mind, there are certain things happening which may mean that there'll be a different paradigm of regulation in the next 20 years because of some of the work that's happening today, and that's what we'll look at just in the last half an hour after a break. How long do people want? Just a moment, or do you want to?
10 minutes or something?
Yep.
10 minutes shall we have?
Okay.
Maybe back at 12:05, have coffee and... Is that right here? Yeah, okay.
10 minutes, you can check your phones and see life's okay.
Have a break. Cheers, guys. I wonder if, I think, because I always latch on to the last thing I hear.
Yeah.
I think that redress thing is very interesting. And I wonder if anyone's analysed that in terms of having that as either a measure of the strength is the right word, efficacy of regulation between regions and countries. And I wonder if it's easy to get hold of, relatively easy to get hold of data.
And in international comparison, I doubt it, but it's worth looking into. But because there are not a lot of places that have as sophisticated an ombudsman system and transparent as we have. It probably publishes more data than anyone does. The US, of course.
I wonder if a different state by state in the US as well, would it be?
Yeah, but also, well, it depends. In insurance, yes, they'd be state-based, but of course in the other areas, it's all litigation. It's class action.
Yeah.
So they wouldn't go to an ombudsman. You'd just bring a class action. So you can look at those.
So you could compare across, but it's not. Yeah.
How much is it a class action? How much a?
Yeah. Anyway, I'm going to stop students. So do you want me to get you another coffee? Do you fancy a little
No,
espresso
right,
or something like that?
No.
I'll let people talk to you, okay?
Yeah.
Yeah. Do you need anything else? Are you okay?
No. Yeah, I'm all right.
Usually it's fine, just bring 2 minutes. So you attach that and also write my letter. So those are your so they're not good. Not make it up. So you receive the emails from you. So it says from yeah,
I mean, the whole point of
and in my lecture, my lecture, I will also so it's true that but you know, which you copy.
Maybe good content and something.
Because it's wrong. Yeah, so there's something.
So maybe useful when you go to the park, but if you have a gun going on,
That's right.
But the point is that I don't see wrong. But if you bring them in, instead of copying this, it's also wrong. Yes, it's yes.
Just bring the whole web page into the PDF.
Do you have a web page with the photo
I think we should have, but I
We should have, yeah. Because at the end, it's don't worry. Because if I put it on the web, that's fine. Then trust me.
or can we ask for some money?
From the office, yeah, but she won't make it because in China, because in China they have stars. And we don't have stars, so that's the thing. But I'll vouch for you. You have a special guided paper. Yeah, but I can do it. So the problem with this one was that you take your own data. Yeah, it's 40%. Now, the manual also wrote it properly. It's not just about copying. If you accept the manual, it breaks the system. Okay? So what the manual is for is that it's not about the manual. It doesn't matter. It's not good. You understand me what I'm talking about. Okay? So I know that you guys some issues with this. So what I'm saying is, don't be too worried about this one. Now you have problems, then the service out. So the mistakes you've done for the first question is you didn't because you didn't this basically you lost the here because of also because this is the 45. Yeah, once you are taking the 45.
不是我是说，我只是你这样子写的话，下面那个改掉。但是又没有点呢，我靠！这我也是，我查都查不掉。没有点呢，然后我在想，当时我在想说，是答案错还是真的比较低呀？然后我就答案就没点，后面加一个花。这个。哦，还有这个运动是，然后这个，
No, in this I make a good one. I don't think that's 4 points change. Yeah. What you should think is that because you have to
钟表的那个。
don't need to be
我怎么知道？
I'm sure I know
If you regather.
Can you put bigger than that? So that's the condition for restriction.
Yeah, very
Here it is. So it's space.
Okay, should we start to regather?
Yeah, we can talk and sit. Guys, go back to your seats. Give me the scripts. We can discuss that later at the end. Okay? Give me the scripts. Let's assume the direction.
As you know, you having just had your papers back on something, success and failure are both imposters. Right, I want to just touch on some of the modern approaches that are changing how regulators interact with businesses. I appreciate some of you, it won't matter, but hopefully one day some of you will have money and at least you'll be investors and think about your own stuff, and the world will be different in terms of maybe some of how regulation occurs. This first one, this acronym RDR is a UK acronym, but it's the Retail Distribution Review. But this is about commission bias. I don't know whether you have experiences in other markets, but certainly in the UK, across Europe, in the United States, in Canada, Japan, it is quite common that advisors are paid by the product providers for sales, so that when you as a member of the public go and see a financial advisor, in many of these countries, when they advise that you go into a certain product, the product provider pays money to the advisor to thank them, to remunerate them. And some people in many countries got advice for free. They saw it for free. Obviously, in economic terms, it was not for free, because a payment was taken from the product and paid to the advisor, and therefore that reduced, of course, the overall performance and return that the investor had with the money they put up, because some of it had been redirected in a non-performing sense. Now this, for generations, was thought to be entirely acceptable, just as it was in the pharmaceutical industry for doctors to be paid by drugs companies for prescribing their drugs. Now this is now seen, in the same way many things change from being utterly acceptable to being utterly unacceptable, as utterly unacceptable in the UK. You cannot receive commission as an advisor from a product provider in this disguised manner. And the UK did a lot of work on this and essentially brought in a ban for all product providers, insurance companies, asset managers, banks, from paying commission to third parties where those third parties were meant to be under a fiduciary, a full obligation to advise people in their own interests. Because if you ask any human being, did you do something in this other, have you fulfilled your role properly? Of course all of them used to answer, yes, I've thought about all the right things, and this was the right product for this lady, or this was the right product for this gentleman. But when you looked at it statistically, surprise, surprise, the products that were always most recommended and most sold were the ones that paid the most to the advisors. This was the commission bias, and it's still seen, and some countries still permit it. And I would be amazed if they didn't see the same commission bias in those countries, but maybe some places are different. But nowhere has ever found anything other than there's commission bias. Canada has been looking at it, as I say, Japan is bringing in rules on it. The difficulty with addressing commission bias is that it was an incredibly convenient way of making sure people got financial advice. If you have £10,000 to save, or you want to regularly save some money each month, to go along and get advice, which the advice maybe cost you £1,000, would mean a lot of people just wouldn't bother. And what has happened is that in the United Kingdom, less people now get advice. So although it is now clean, the relationship, any payment they make, they can see, they either pay up front or they agree to some payment structure. Because they're now aware of the cost of this, less people are going, and there's been a behavioural change. And so we have a problem in the UK because we want people to get advice and less people are going. But, so the commission bias, whilst in one sense is quite wrong, some countries are concerned that if they close that off, all it will lead to is people won't get advice. And is it better that they at least get advice, even if it's because they don't understand that there's a disguised payment being made? And this is the whole issue over to what extent should a state be patriarchal and look after people for their own good, and to what extent should people be allowed to make their own decisions, even if that decision is a poor one. I'm not going to get advice because I now have to pay up front. Canada has done a piece of work on this in which they've looked at this and they're trying to work out, they were last time I looked, still trying to work out how they're going to resolve this. But this has been a big move, and it has changed the investment research market across Europe as of the 3rd of January. Research may no longer be paid for except by cash. This whole move on inducements, on payments between different providers, where people are meant to be acting in the best interest of investors, but actually we're getting other payments from other people that could influence them. These are all being stopped wherever they can be. There used to be rules where if you put trades as a trading firm on an exchange, there's a cost always with the trade, and there used to be tariff rebates if you put huge volume through certain trading platforms instead of through other trading platforms, and bans are being brought in on these things. Because what always happens is if you offer a capitalist an incentive, the capitalist will take the incentive but tell you that they haven't been distorted in their assessment, and that's just the world, you know, because and all I'm saying is that's on a sort of statistical basis, you will always come across these biases. And a lot of what regulation is now looking at is how are these biases, where are they built in, what are the things that we need to be addressing. And as I say, commission between advisors, the way in which research is paid for across the capital markets have both been banned, and there are other areas people are looking at. There are a couple of other things that are sort of emerging in the way that regulators look at stuff post-financial crisis, post-realising that for all the efforts that were taken, it didn't really stop terrible things happening. For all the efforts that are taken, people are still losing huge amounts of money through bad advice, although they're also gaining, you know, in other areas, but it's just not good enough. And behavioural economics, surprise, surprise, is one of the things that regulators are talking about now. For generations, literally, the whole way in which information asymmetry, you know, the fact that I as an investor don't really know everything that the bank does when the bank sells me a product, you know, this information asymmetry that leads to poor outcomes, the whole way in which this was addressed by regulators for 20 odd years was through transparency, through information being provided in more less form to investors so they could make their own decisions. And what people have realised again and again, and of course the behavioural economists have helped us see this from an academic point of view, is that that is a load of nonsense. In the limit, it just doesn't help. Telling my mum how a product is put together that ensures she has a fixed interest mortgage, let's say, and understands that, and if any of you have looked at what you do in your sort of finance maths, but if you've ever looked at how the banks put together fixed interest rate mortgages as opposed to floating ones, these are very complex products in terms of the derivatives you need to use to track and make sure as a bank you still make money, but you deliver to people. It's a very complex product. Telling my mum or me how it works is really not going to ensure I make a better decision or my mum makes a better decision. And so the developing work is all about nudges. It's all about looking at how people actually respond and whether we need to change our focus of regulation on providing people with more and more information in a form that, I coined a phrase some years ago, is legally comprehensive, but it's utterly incomprehensible. You see what I mean? It's got everything in it, all the pages you'd ever want, but you actually learn nothing. And this is a big area, and more the regulators are doing work with cohorts of consumers to understand how they actually react to stuff. Amazingly, for years, the regulators were producing disclosure material, and the European regulators were producing disclosure material for consumers, saying they need all this information, and they were not carrying out any consumer testing whatsoever. They were classically working on the basis that occurs of people in a sort of closed, intellectualized industry, presuming they knew how to communicate to people who they saw as being less informed and less clever than them in those areas. And this sort of aristocracy is being addressed, fortunately, by the academics coming in, and this, tremendous work in other areas, just showing how the sort of aristocratic method is wrong. And that's having a big influence and a change, and you'll see the UK right on this. The other area is personal responsibility. And it doesn't matter, it's for another day, but if you ever want to have a chat to me about it, I think, I've said before, I'm still not sure that the creation of limited liability companies was a good idea. I do understand that having limited companies, legal persons as companies, has some advantages. And everyone will tell me that it's led to great development in trade and such like. But on the other hand, and surprise, you've seen in papers about Carillion, surprise, surprise, if you ask executives of a huge business to run that business and decide whether or not to look after consumers, to have money for the shareholders or pay themselves more and more in salary, and you tell them that if it all goes wrong they have no personal liability, trust me, it does go wrong. And Ian Rankin, the author, in a book he brought out a few years ago, fiction, proposes multiverses. You've heard the quantum idea that they're multiverses, infinite number of alternatives. Yeah. So he writes his fictional story is all about a person who lives in multiverses and can jump between them. And when he looks at the financial markets, the one difference he sees between those worlds, universes that have long-term sustainability, and those worlds which collapse and have collapses, is the creation of limited liability. Now, I'm not here to tell you that we should change the whole system, but it is the case that personal responsibility, director responsibility very often, is something that people come back to again and again and again. When they're good times, everyone forgets about it. When there collapses, people always look for the individuals and ask what was their role. And the way in which regulators are developing this idea is that although, it's all right, it's not a corporate law lecture, don't worry, but the notion on companies is that the board acts as a unitary body, a single body with a joint responsibility for any decisions that are made. It doesn't matter whether you personally vote for them or not, you have a joint responsibility. And that's a great thing because in a sense no one gets pointed at. And if things go wrong, it's sort of the board, and it's a bit amorphous. And what the regulators have brought in the UK and others are looking at across is identifying individual members of the board as having responsibility for certain areas and certain things that go on. So that in a huge bank, an investment bank, there will be individuals who are the can carriers, say for the commodity trading arm, the can carriers, the responsible people for the risk management that goes on. Obviously the FDs generally for the financial side. And the new rules are basically saying that if something goes dreadfully wrong, there's a semi-presumption that you have failed unless you show how you worked at it. And there's been, therefore, a greater personal responsibility put upon people in a way that actually they've been sheltered well, look, I'm a non-exec director of an asset manager, running not huge, running more sort of in the region of 10 billion than huge numbers. And I have a personal responsibility, but I also will be a can carrier for various things. And this is the new approach as well, to ensure that individuals can be addressed. And the reason for that is there's a belief, of course, that if you feel that in taking a step or failing to take a step, you personally may become responsible, fined or banned from the city, you personally may be made liable, you're clearly going to have a different viewpoint in making that assessment, day in, day out. Not always, but day in, day out, there's a likelihood. So this is the thing, it's called the Senior Management Certification Regime.
I mean, I think that's very interesting, and when we talk about personal responsibility, the danger is, of course, being reasonably backward-looking when we're in a world where maybe advice will be given, loosely speaking, by artificial intelligence, but in particular where more and more trading, and of course very popularly Bitcoin, but more and more of our trading will be held on blockchain. Who does anyone hold responsible for it? Where does the responsibility hold if Bitcoin goes terribly wrong? Or some of the other cryptocurrencies? It becomes very decentralized. I mean, who's responsible? Who can the law find in any of those things? So forward-looking in terms of personal responsibility is becoming more and more difficult, I think. So, but anyway, I just thought
Yeah. No, listen, I agree. One day we're going to just get hold of the person who wrote line 1000 in some code and then realise it wasn't them, it was a supercomputer, and we'll have to imprison them. The other area that has changed, and again, Belgium had a little bit, this is definitely not the US model, but the UK is dealing with this, and the other European regulators are looking at this very carefully, is the financial service regulators have been given competition powers in the UK. Now, I know before I said about making sure that the markets are competitive, but these are genuine competition powers. So the financial services regulator is now allowed to go in and conduct an inquiry into a market in the way that a competition body would. So they can look at cartel, they can look at wide competition type views on inefficiency of pricing and lack of competition. So whilst before we used to look at conduct and behaviour, now they're being equipped with a much more integrated view and set of powers to look at how markets operate. Basically because to date the rest hasn't really worked very well. And I'm just going to touch upon one area as I close. That this is coming to play, and I appreciate you're more computational, but I just want to explain a couple of things to you very quickly by way of background. Asset management, there's a whole ton of different ways in which asset management occurs. There, discretionary management, you can be a high net worth individual and you have an individual portfolio run for you because you had it bespoke made, less and less of that. You're going to have open-ended collective investment schemes, closed-ended schemes like open-ended hedge funds, closed-ended hedge funds, open-ended standard equity funds, and there's real estate and things like that. And you look at this. Now, don't worry about all the texts here. Faced with huge amounts of evidence that people make poor decisions in deciding what to invest in and what not to invest in, the regulators have been trying to think what they should do. And as I said to you, one of the things they used to do was transparency, more and more disclosure to people as if that was going to help them. And the evidence has shown that it hasn't really helped, hasn't really changed that much. Of course, getting rid of commission bias helps, because instead of somebody trying to push a product at you just because they're going to earn a lot of money from it, and you might not, that's hopefully ending. But there's been another theme developed recently, and it's a particularly interesting development because a lot of people think that it's not for the regulators to do it, or if it is, it's a very strange way in which they're approaching it. I'm not sure, actually. I think there's sense to some of this. And it's essentially this. What is value for money? This is the question that the regulators are now asking. When you look at a product, what is value for money? Because lots of people can get very excited about how different products operate, and frankly, if I need a mortgage to buy a house, then my assessment is great, that's going to be a mortgage and I can afford to pay for it. Great, but is that the best value for money? What should be taken into account? And there are a range of products, of course, in which you only really know over a 20 or 30 year period. So the UK, like quite a few of the more right-wing Western economies, is shifting the responsibility for retirement from the state onto individuals. You may know a lot of people now are having to fund and take out their own pension, but the state no longer provides it, and big corporations no longer provide it. You'll see in Carillion that has collapsed, it has a defined benefit scheme. This is a scheme which essentially, well, like the academics here have, USS runs, which is a scheme in which essentially there is a broadly based promise that at the end of it people will receive a certain amount of money, a salary, the retirees will get certain payments each year, and the assets of that scheme are essentially managed as a hedge against that liability. Okay, that's what goes on. They are a hedge on a sort of cash and liquidity basis as well. Hedge against this promise. And the promise exists, and then this is done to hedge that ability to meet the promise. But more and more people, like myself from the private sector, actually what we do is we build up a pension pot from our own money, and what we get in retirement just depends on how those investments perform, whether they go up or down. There's no person with an intervening promise that might mean the next generation are going to pay for this generation's payments. There's no maturity transformation in that sense. It's an immediate thing. Okay? And because of that, they're very concerned that people are not going to end up in 20 years' time, 30 years' time, and realise that they've made a dreadful error and they don't have enough money. They want people to have good advice and to get value for money, because you may know, if you look at any sort of what's the word you guys, you know what I mean, aggregation over time, if you take out small amounts of money down here, has a certain impact after 30 years. If you take large amounts of money here, you know, once you start doing that, that can make a huge difference at the end of that curve. And so they've been looking at value for money because of this trend in society to shift retirement risk from the state to individuals. It's of course a trend that could be significantly reversed by other administrations, but this is what we're doing at the moment, this is the way we're going. And because of that, value for money, as I say, has become very important. Now, if you have a long-term insurance policy, and that policy has a discretion to give you bonuses, additional amounts if it seems as though the investments have gone well, then people have to make a decision whether to give you a bonus, people running the insurance company, use some of that money for their shareholders, or pay themselves more money as directors and successful people who are, you know, masters of the universe. It's always that phrase, you know, is male. And because of this, there's been an issue with what we call with profits bonds. So basically where an exercise of discretion had to be made, where it was felt that it was not being made fairly. It doesn't matter whether or not it was or it wasn't. There's some circumstances, I'm sure it wasn't. There are many circumstances in which it was. But the fact of the matter is, what the UK introduced is this thing called an independent governance committee. And there now exists at insurance companies for certain products an independent committee that has to assess whether or not it's been fair, the way in which distributable profits, bonuses, have been put out. It has to look at, it assesses each year, assesses this thing, ongoing value for money. Now, I hesitate to say, but in a sort of classical sense, normally you think that value for money assessment is really a utility assessment to be made by the individual in buying that product. But actually what the regulators are doing is they're putting the value for money assessment on the product providers. And this swing to recognise that people won't make the right statement. So they're bringing in independent groups, knowledgeable, to make value for money oversight assessments on what the executive are doing. And this is the big trend to try and address this problem. In insurance policies we have it already. There's an assessment of ongoing value for money for the relevant policyholders. So you imagine the cohort and you make this assessment. You have to look at the default investment strategies. Are they designed and executed in the interests of policyholders? So whilst before people would have expected that the market worked by individuals making rational assessments and then applying their capital in different places and withdrawing it, we're recognising that this does not work. And therefore we're bringing in new tools. People are bringing in new tools to address this. And look at this. Whether the characteristics and net performance of the strategies are regularly reviewed. Whether core financial transactions are processed promptly and accurately. And here, the levels of charges borne by relevant policyholders. So what people, if you imagine car manufacturers doing this, people are being asked now from groups inside them that have access to all the information to make an assessment and publish basically their margins and to assess whether or not they're making too much money. And the rationale, I think, and the justification, apart from the failures of the past, the justification is this. This is not about buying a car. This is about people whose money is being managed by someone else, if you will, and their responsibility. These businesses, including mine, and these businesses, what we do is we look after other people's money. And therefore it's seen that this sort of fiduciary relationship entitles the regulator to come in and get involved in a different way than who would say that BMW and Audi should publish what their margins were on different models, and somebody sit there and say whether or not the BMW 320i is value for money over the BMW 323i. But in financial services, this is the direction we're going. Now, value for money is clearly not merely cost. That would be obvious. You could publish that. It's to do with risk, it's to do with accuracy, it's to do with necessary services and things like that, as opposed to tinsel that people like to make it. This is, the level of charges, the direct and indirect costs of managing, and they make an assessment. This was the first phase, the IGCs. The second phase has become potentially more extreme. I'll come to that. Now, before I do this, and you'll look at this, it's quite hard to see these charts, isn't it? This is a UCITS. I don't know whether you know what a UCITS is. It's undertaking and collective investment in transferable securities. It's what you call a mutual fund, an open-ended mutual fund. And this is a classic structure of a contractual UCITS. Here you have the sort of contractual document that says what your entitlements are as an investor and what will be invested in. Here are the investors, the unit holders. Then you have a management company that is basically running it in responsible and regulated terms. That's the sort of thing I'm a non-exec of. You have a depository, a person who separately and independently from the management company holds the assets. Very important. It's always a thing called 4 Eyes. Certainly in Europe, the mutual fund industry operates on the basis that the assets are held distinctly and separately from the management company running the business to allow an additional safeguard and oversight. So as an example, if you're running a bond fund and somebody started, the manager of that started carrying out derivative trades and it's not allowed, they might be doing that in the management company to try and improve the performance. Hopefully the internal systems here will stop it. But actually, in the European mutual funds, the depository will then just say, no, I'm not accepting that trade into the ownerships that we have you're not permitted to do that. It's an oversight role, safeguarding role of auditors, and then lots of things are outsourced, including maybe the investment management, the ways in which what we call transfer agencies, the buying and selling the units. Okay, so this is what the structure looks like. So you have this management company, various different players, and that's what we have. Now, what the regulator is expected to announce, probably in the next month, is a new view on value for money obligations at funds, and it's developed from the independent governance committee that made an assessment and just reports. And it's looking at some additional things. Now, this is the proposal, and it may well be they don't go with it, but I just want to explain how much further the regulators are pushing stuff now, potentially, in response to this, to be fair to them. There is to be, this is their proposal, it may not be used, there is to be a proposal that there will be a value for money assessment made and probably published for every fund, and it will include a statement whether there's savings and benefits from economies of scale that should be passed on to the investor. Which is a very radical thing. I mean, nobody suggests that Apple should reduce the cost of its iPhone X once it passes a certain number of sales, because with the economies of scale, the fixed cost involved in it is now being amortized, and actually you can therefore, given that basically you only have the sort of material cost after that, you can then sell it at a cheaper rate. And actually the regulators aren't saying that the funds can't do that, but the regulator proposal is that people will have to look at whether there are benefits from economies of scale that are being passed on. Now, the assessment of charges, the proposal is that whether the level of the charge and other payments taken to the property is reasonable in relation to the costs necessarily incurred. Let's say you have a fantastic performing fund, and it's so brilliant that everybody is perfectly happy to pay you 65 basis points a year to own it, 0.65% of the assets. And it sells. Why shouldn't you sell it? But actually this may say, hey, listen, looking around, it doesn't really cost you that much to run it. And we'd like you now, your independent group, to publish a thing saying, it is quite a lot of money. Now, what I haven't told you, which some of you may know, is actually some of this already occurs. But it's just getting a bit more formal and radical. And where it occurs is this. In the United States, for quite some time, funds, when they get very large, they have independent boards, funds, okay, in the US, much more than you see in Europe. And when funds get very large, the independent board pushes against the management costs, because it's one thing to say, I want to be paid, let's say, 30 basis points for managing this fund, and doing the investment management, the research and analysis, maybe 30 basis points, maybe 20, might be the sort of rates that people get from it. That's one thing if the fund is just a small fund. It's maybe got £100 million in it or something. There's a certain amount of money you get. Or if that fund gets 10 times the amount, why should it cost 10 times to make an investment decision and research just because you now have 10 times the size of holding in Apple than you did before? You're still researching in Apple, you're still just making a decision to buy or sell. It just so happens that the aggregate number of investors you've got is that every one of your trades in absolute terms is larger, even if your weighting stays the same. But they'll receive 10 times as much money. So in the US, what you see is curves. And very often, once you approach certain sizes, then the rate goes down. So you may then drop to being, if you're Vanguard, you may drop down to whatever, 6 basis points. So on their very big funds, maybe it's even subsidies. I don't know it's Vanguard, but they're very big. That's why they're one of the biggest in the world with BlackRock. So you do see this already, and that's come from these independent groups. But what you don't particularly see is this way in which we will now, the expectation is that comparable market rates will need to be published and looked at. I mean, famous last words, because everyone's a bit up in arms about it in the industry. But I mean, I think this is the sort of thing that is doable. I think you can explain, and frankly, if in response to people seeing what you do and where you're making money and such like, they're not satisfied with your fund, then they're not satisfied with your fund. I mean, most people will still make decisions on net performance and look at that. And the net performance is what matters to them. That's their experience, you know, the money they put up and what actually they get back. The fact that company A running it is taking a slightly bigger slice than another of the players that are managing it, and there's a sort of different ways in which whatever is carved up is carved up. Most people probably won't be concerned, but this will at least give people a view that once you get very large as well. Another thing that's being proposed is that there'll have to be a statement of whether the level of charges and payments taken from the property are commensurate with the quality of service provided. These are things that, assessments that to date everyone has always believed in an open market are essentially ought to be determined by the market itself, by people buying and selling, making their utility judgments, you know, reporting on what they thought, other people being influenced on, you know, the TripAdvisor type responses and all those sort of things. And actually, the idea is that this independent body will now bring about a greater assessment of the value for money. What you've seen, therefore, is that, I hope, is even if you never have to look at it again or you just notice it in the newspapers, regulation used to be thought, I think, by a lot of people, particularly in the city, as just a pain in the backside. It was a necessary document, a bit of box checking is often said. You know, to be done, we need to fill in these forms so we can do what we do. But actually, the way the regulators are addressing things is they recognise that there has been a profound societal change. The views of the public as regards the city and what it does, financial crisis and the loss of money a lot of people have, the risk that governments are now putting on individuals, in between this big picture political view to now put retirement risk on individuals, the regulators are changing their agendas to ensure as best they can they're using these more modern approaches of behavioural economics, of independent bodies, more and more trying to work on all those misaligned incentives that exist. And that's separate from a whole raft that coherent with a raft of work that I'm sure others will talk about, or you will see in the papers, that it's much more visible at times, on the whole sort of ethics in the city and how traders trade and behaviour, and that work that's been going on for generations. Because when the financial crisis happened and government said and industry got together and they said they were going to work on ethical behaviour of traders. You see the SocGen guy was back in the papers again today. If you want to look at these, last week, you look at these things, guys who did the trading. When they want to look at this sort of ethical behaviour, because as history has shown, very often some of these things on trading and insider dealing, probably the aggregate economic cost to the country far outweighs all these mis-sellings. Most stuff that goes on, the actual losses to people come probably far more from market abuses. That's the argument. And the work has been done for generations on ethics and behaviour, and I think that is an area in which, although it's still being done, again, I think the regulators are sort of moving on from that. So on the one hand, trying to inform people, on the other hand, hoping that traders will behave nicely. It's sort of now coming together in having independent oversight various key things, a reduction of those misaligned incentives if you can, and personal responsibility over whoever he or she has got at the head of the traders, knowing that if one of those people blow up and does something wrong, that person on the board may now be found to be responsible for it because of their role, not because they were involved in it. Those are the things that are sort of going on. Anyway, that's a sort of overview of regulation. Hopefully you'll never have to get involved with it again, and hopefully you won't blow up the market with your amazing maths. So anyway, thank you very much.
Thank you very much. You got any questions for Guy about any of the things that he was within there, in the context of things that you know in terms of financial markets and what's going on?
Do people expect to work in the financial markets? Is that why you're doing what you're doing? Do you want to work in there? It's worth doing. They won't have replaced you all by AI by the time you get there. So.
Guy, are there, you talked about, I think, probably what you could call regulatory arbitrage earlier on, which I think you were sort of suggesting that some environments may, particularly in trying to represent a country, have less regulation, so to speak, than others. On the other hand, are there regulatory environments which you think are better long term? So, for example, Canada is often held up as an example where there hasn't really been a financial crisis relative to other places. Does it have a better regulatory environment? Is that the reason why, or is that very difficult to say?
So I think there are two things. One is
quiet for a moment, please, unless you've got a question.
One is the. It is definitely the case that London and, to an extent, New York have always promoted themselves on the basis that they have strong regulation. Amazing. And the example of where then that's gone too far would be Sarbanes-Oxley and the sort of requirement to have even more regulations in accounting. What I think is the case is that the difficulty is that even if you seem to be good, say Canada, basically the main thing that comes from it is that the head of your banking regulation becomes governor of the Bank of England.
Yes.
It isn't that people then decide that Canada is the place to base their global businesses, because we're pretty well maxed out on sort of core huge centres at the moment, and they have a momentum. So the difficulty is that for the really big business, it's going to come to the multifaceted sense of whatever the regulation is broadly. And actually the regulation then is just a fight between New York and London, or been in the last 15 years, sort of who gets it set right and not. In the smaller countries, then sure, there are places in which there are some types of funds or some types of banks which would just never be allowed elsewhere. But much more of that battle now is on financial crime, and that often the low regulation has been associated with criminals seeking to use those areas to hide money and use assets in those areas to hide money, and that is a sort of global thing that's being addressed. So the countries that are pretty poor at financial crime pretty quickly get isolated. So for example, if you're a regulated firm in the UK, there are some places in which it is extremely difficult to satisfy yourself that you could take money from an individual who's based there. So you just cannot do business with them. If you're in banking, there are some countries where there will be a higher capital cost for transactions with those countries because of their regulatory oversight, and therefore there is an enormous disincentive to do complex trades on balance sheet with those people. The group of countries that are really bad is still pretty small. It's 20 probably of the 200.
Okay. Guy, thank you very much. Thank you all very much. Next week we'll have Barry Moore, who's a private equity investor, worked in the city for many years. Lots of very interesting examples of how private equity has changed over the years and how deals are put together. So that's going to be very interesting. So I look forward to seeing you next week. We'll circulate Guy's slides. And so let's thank him in the usual way again. Thank you, Guy. Have a good weekend, everybody.
Yeah, I do have one question for Saddam.
I mean, one thing we didn't talk about, well, what I thought these guys might ask about it, was particularly given China and its slow harmonisation. What's that going to make in terms of London, New York, or Shanghai? What difference will that make to regulation? Anyway.
Yeah, I mean, it's one of the reasons why cynical wasn't the best day when he was moving. Clearly, it's G20.
Yeah.